Well, hello there, everybody. It's time for another one-on-one, and the timing is pretty good, I think, to have on this next guest. This is just by happenstance that I had booked Mike Fratantoni, one of my favorite people in mortgage. He's a chief economist at the Mortgage Bankers Association. I dare say Mike is one of my favorite people, period, not just in mortgage. Mike, are you willing to take that moniker on?
I appreciate it very much, Greg. Appreciate the opportunity to talk with you once again. Always enjoy our conversations.
Well, I'm wearing a blazer. This is not, I usually don't wear a blazer for these things, but I was like, you know what? If a sub 4 bond, are you serious? Like 8 months ago, I thought we were heading to a 5 handle. Now we're looking in the 380 range. What in the world is going on?
Yeah. I think let's start going back a full week ago. We got a couple of reports. One, the JOLTS report showing hiring is slowing. You had unemployment insurance claims were up. You had the FOMC meeting where Chair Powell in the press conference afterwards was really looking like he was struggling to not promise a cut in September. Obviously at their July meeting, they didn't do anything, but he was leaning into that pretty hard. And then we got the July employment report on Friday, unemployment up to 4.3, job growth slowing, wage growth slowing, everything pointing towards a slowing economy. That was last week, and we saw bond yields really respond to that. And then over the weekend and then into today on Monday, you had stock markets globally just plummeting and bond yields dropping again.
Yeah, at last check, the bond had gone down somewhere in the 370s. Now it's bounced back up around 3.8 at last check. Of course, we're live right now, so it's a little after 1 o'clock Eastern. Are you surprised? Are you surprised by this precipitous of a drop?
So you've been following our forecast, right? We thought the U.S. economy was going to slow. We thought rates were going to drift down. What's been interesting the last couple of weeks, though, is reading some Wall Street research. It seems like folks were getting ready to make this move, right? The hint that short-term yields were going to drop. You have a lot of investors, $6.1 trillion in money market funds right now with that variable rate. They wanted to lock in returns. So they were sitting on the edge of their seat. The instant it looked like short-term rates were going to drop, they wanted to move out the curve. For our industry, this was a good moment, right? I was talking to some lenders last week and I was saying, look, get up on your toes. There's going to be an opportunity here. I don't think the fundamentals support a 3.7 10-year rate, given the outlook for growth, the outlook for deficits, outlook for Fed policy. So I expect we're going to only level out probably closer to 4. But this is a moment right now. If you have some borrowers that could potentially want to refinance, this is the time.
Yeah, and I've been watching the pundits all day, and you're hearing both ends of the spectrum here. I'm hearing some say that this is an indicator that the Fed completely missed it and that things are much worse than they thought. And then we're seeing other people that are saying, hey, this is just back to a more normal level and the economy is functioning just fine. Are you right in the middle on that? What side of that fence are you on at this very moment, August 5th? Obviously, it's a moving target.
Yeah. So really, last October in Philadelphia at our annual convention, we thought 3 rate cuts this year. We held there until this spring. Inflation was a little stickier than expected. We dropped to 2 in April. We were at 2 in July. I think, you could make a case now for 3. We're going to make that decision before we release our August forecast in a couple of weeks. But I don't see anything beyond that, right? So maybe a September, November, December. I don't think there's a high chance of a 50 basis point cut in September. I think markets are way overreacting to the news right now. If you look at that job report from Friday, some of the weakness honestly could be coming from hurricane impacts from Hurricane Beryl that hit Texas. That's really transitory, to use a word that's fallen out of favor.
Oh, my goodness. Don't use that word. We've heard that one before.
Right. But you think about it. I mean, the unemployment rate's at 4.3. The Fed would be thrilled if we leveled out at 4.3 for the long run. Inflation, PCE's at 2.5. They want to get it down to 2. So nothing in the fundamentals is screaming that they need to make a cut. My worry is if they sort of listened to some of the pundits today and made an emergency cut before the September meeting, that would just lead to outright panic. That's like, what do those guys know that we don't know? There's nothing in the economic data that would support that right now, but we'll see. One thing I'm watching, end of this month, we'll get the report from the FDIC about how the banking sector is faring, right? So we know that banks have been dealing with a lot of pressure because they're having to pay more for deposits. Their balance sheets are a bit more constrained than has been the case. There's some credit losses coming from their commercial real estate loans in many cases. The big public banks, they look like they did okay in the second quarter. I'm going to watch to see how many of the smaller banks began having trouble in the second quarter. That is something the Fed could react to. If this, sharp inversion of the curve between the Fed funds rate and the 2-year is putting a lot of pressure on banks, the Fed might have to intervene to loosen up some of that pressure, because they're going after an inflation target. They want to keep employment at full employment. They're also concerned about financial stress. So that will be the other thing to watch.
So many variables. And for the last, I don't know, 2 to 3 years, you and I have had so many discussions, more than a handful, about, not if, but when. And I'm not sure anyone has gotten it right until, about right now, because it looks like we're finally in that cycle. Does it make your job more enjoyable when rates are heading down versus when they're headed up or elevated? I'm just curious for like the inside window into Mike Fratantoni's world, when he's not constantly being asked, what's it going to look like at the end of the year, or how much are rates going to go down this year? And it's finally like here and happening. Is it an exhale moment or just par for the course?
Well, I mean, I really enjoy the opportunities I get to go out into the industry, talk to folks at their events, at our events, virtual, live. I enjoy talking about the market. I find the mortgage market absolutely fascinating. I view my role is to lay out, here's a baseline. You don't have to agree with me. Most people don't agree with me. I'm fine with that. But if people say I'm more bullish than MBA, I'm more bearish than MBA, that it's useful for me to put that baseline out there. And then I think it's also useful that we only slowly adjust that baseline, right? We're not like the market. We're not minute by minute changing our views, because we can be a consistent indicator. Now, I have to tell you, for the last couple of years, when I'm talking about lowest volumes on a unit basis since the mid 1990s and 70% drop, peak to trough in dollar volume, and 35% of the industry laid off, right? That's a tough conversation to have. So I'm happier that, last couple of months been able to say, look, it's turning, This is not a great year, but we think it's going to be a better year than 23. And we think 25 is going to be better than 24. So folks that have sort of managed the storm so far, I think next couple of years are going to look better. And again, this is an opportunity, like right now, if you have a refi capability, you got some customers you can make happy right now.
Yeah, let's jump in on that forecast because, that too is a moving target. I think at the beginning of the year, you had roughly 1.9 trillion in mortgages, right? And you adjusted that forecast as rates stayed more elevated down to, I don't remember the exact number, but tell us what that number was.
175, yeah.
Okay, so, down, what's that, little over 10% from the initial forecast. So like, how do you look at those numbers? Is that something where you see a drop like today and you say, all right, well, if rates were to stay in the 6.5 range, well, I can just hit a couple of buttons and adjust my forecast and spit a number out right now? Like, what does that process look like? And when might we hear of another adjustment? I know we're running out of time, but we do still have 5 months roughly left in the year.
Yeah. So if you think about our forecast process, we have a large scale model exercise that we run each month to update the forecast, but it's also very much informed by the current data. So we have our weekly application survey that really gives us a nice bead on what's happening right now. So this Wednesday morning, 7 a.m., you'll see what happened last week. So that was partial week with a big drop. And then probably a week from Wednesday, we'll see what happened as of sort of today and whether this rate level is going to hold. That may cause us to, in that sort of mid-August forecast that we'll roll out, but we're going to adjust based upon what we're seeing. And an app taken today, is that a third quarter origination, or is that even a fourth quarter origination? It's going to change our view. And the other thing that I'd really highlight on the purchase side is we're beginning to see inventory rise. We've seen new home inventory go up, and now existing inventory beginning to increase more in some parts of the country than others. So your home buyer is not going to decide to buy based upon a rate dip today, but maybe they'll buy later this year, right? If they're thinking they want to get ahead of next spring's market. So I think nearest term, yeah, look for us to move up that refi forecast once we sort of pencil in that rate path. But I think there's opportunity now on the purchase side, and we're looking for 2.1 trillion in 2025. I think there's some upside to that if rates come in lower than we had in our last rate projection.
What do you see as the rate that's going to really loosen things up and return to some kind of a normal inventory amount and normal activity? What's that rate need to be, to really loosen and shake things up? Is it 6%, 5.5%? What's your sense on that?
I think below 6, and you're already seeing it that some of the prepayments on those deep discount securities are starting to come in faster than people had expected, right? So, and it was interesting if you look at where that's happening, sort of middle of the country, lower home values, smaller loan sizes, and so the lock-in effect is just not as tight as it is on some of the coasts. So it's going to differ market by market, but I think as we move below 6, and today I imagine we're well below 6 for VA loans, and FHA is probably getting pretty close. That's where sort of the more responsive part of the population has been on the refi side.
Construction, that's been a very popular, busy avenue. Home builders historically have been around 10% of inventory, and they've been well above 30% for some time. As we return back to some kind of normalization, are builders here to stay at that big of a number, or are they going to come back down to earth a little bit? What's your guess there?
So think about the demand side. We're still forming about 1.5 million households per year, and total housing starts are struggling to get to 1.5 million, right? Beyond meeting that new housing demand, homes need to replace old stock that gets demolished, and there's also fires, hurricanes, everything that could damage homes. So we just are not building anywhere close to enough homes. So I think construction is going to be a strong, bright spot of this market for years to come, probably to 2030 or so. That said, what we've seen is particularly the largest builders are very responsive to any reduction in demand, right? And so we've seen permits and starts dip a little bit, but I would expect that to ramp up again in advance of next spring's buying season.
Well, you look at rates and how they went up. They went down so precipitously post-COVID, or after the onset of COVID. Then they went up so far. Now you've got the builders, as we just mentioned, taking a third of market share almost. Mike, what I'm wondering is, as you look out, the tendency is to overreact, right? To one side or the other. And I'm wondering if you think there will be a danger that there will be too much activity on the home buying front, that zoning could get changed, as it's been. That is one thing that the Biden administration has looked at, right? Potentially changing zoning to allow high-rise condominiums in single-family dwelling areas, like these measures. Do you see a scenario and believe where we might look up in 5 years and there's just way too much inventory and there's some kind of a big housing price correction?
Yeah. So some of the things you're talking about, sort of the light touch density, so where things were zoned 1 unit only, now you can build 2 to 4s or 6 units, or even small multifamily, reducing minimum lot size, all these accessory dwelling units, all these things probably will bring some additional supply, but just at the margins. I don't expect it to have a huge effect. And again, we're so deep in the hole. We're millions of units short of what we need to address the home buying demand, the sort of latent demand that's out there, I don't see stress on the single family market.
Yeah, recently with the
However,
help of, oh, sorry about that. Go ahead. My
I'm
bad. You
sorry.
went you
No,
went for a pause. I jumped right in. So go ahead. Finish up.
I did say single family market. On the multifamily side, we're now oversupplied, right? We still have we still have more than 800,000 multifamily units under construction. They're going to be delivered this year and next year. You're seeing rental vacancy rates rise. You're seeing rents flat or declining in many markets. So that's where we have oversupply right now, is in some markets around the country in multifamily. There might be some interesting potential for condo conversion in some of those places to address the lack of single family. But we're not seeing anything like that in the single family market in terms of oversupply. But multifamily, they're tapping their brakes, and understandably.
I was going to ask you about the work of your colleague, Mark Jones, who's the chairman of the MBA, also the president of Union Home. He helped, along with all the great people at the MBA, push through some much needed modifications to the renovation program and the amount that people are allowed to pour into properties they want to build up. What kind of an impact do you think that's going to have? Is it negligible, or is it something tangible that could really impact the numbers?
Oh, I think it's going to be tangible. That 203K program is a fantastic resource that had really been underutilized because of these constraints, which hadn't been moved in so long, in terms of those loan limits and the ability to do the streamline versus the full 203K program. Now, I think geographically, there are going to be parts of the country that have a lot of old stock that need that rehab. That's where you're going to see the benefit, because you've essentially taken those housing units sort of off the playing field, right? And now, with the right product, you can get homeowners in there occupying the property, rehabbing them. 203K is not available for an investor. So I think this sort of puts the thumb on the scale for that owner occupier, which I think is probably a benefit in this case. But I think you're going to see meaningful additions to supply with greater use of the 203K program.
I want to take you sort of onto the sidelines for a moment, just to talk about underserved communities, because, man, they have really taken it on the chin since rates have gone up, and now we have the fallout from the NAR settlement. It appears as if they're going to move further down the rung here. But without getting too political, any ideas on how that's going to change and what needs to happen in order for it to change?
Yeah. No, it's really upsetting, the fact that the racial homeownership gap is really as wide as it has ever been, going back 50, 60 years. And so, MBA very much involved in any number of programs to try to address that. Our convergence initiative, which is launched in 3 cities around the country, so Memphis, Columbus, and Philadelphia, and now is going to sort of offer the learnings from those 3 cities to the whole country as well. It's a difficult, challenging problem, right? I mean, people have lost trust in lenders. People have bad information about what it would take to become a homeowner. And then the lack of inventory and the cost, really certainly an economic hurdle to becoming a homeowner. But I do think, for better or worse, this is an area where there's not a lot of disagreement across the political spectrum, right? People understand that there is a housing problem in this country, and lack of affordability is not good for anyone.
Yeah, for sure. I appreciate your commenting on that. All right, finally, Mike Fratantoni, chief economist at the MBA, the man of the hour, I'm going to say. Top 3 things we should look out for here as we look to see if the momentum downward is going to continue, or if we could get a bounce back up to the top. You already mentioned that the Fed will pay close attention to small banks. Give me 2 more things for us to look at.
Yeah. So we got the inflation report coming out mid-month, CPI. I mentioned the ISM services data showed prices actually go in the wrong direction. We'll have to see what happens with CPI. Don't expect that's going to counter this move, but definitely worth watching. And then every August, the Federal Reserve has a conference in Jackson Hole, Wyoming. And Chair Powell usually gives a fairly substantive speech at that conference each year. This would be his moment to say either A, You heard what I said in July. That's the course we're on. Think of a 25 basis point cut in September. Or I understand the market is panicking right now. And by the way, I agree with the market. Those are, I think, would be the two ways his speech could go. I think it's going to go towards the first. He's going to say, look, we're watching it. Markets are volatile. I understand why you're so antsy, but we're going to hold to the course we laid out in July. But we'll see. That speech is going to be really, really important.
Yeah, you wonder if he's going to give that some even deeper thought, even if he's not feeling that way, given the fact that the election is coming up, right? And that definitely, you don't want that to enter the fray as a motivation one way or another to either party. All right, finally, give us 3 follows, people that you follow, potentially online. I don't know if you're a Twitter guy or how active you are and who you follow, but whose viewpoint on the economy do you really respect, that if someone wants to follow in addition to you, they can?
Yeah. Well, here I get to give an ad too. So Mohammed El-Arian, who has spoken at MBA conferences in the past, is going to be speaking in October in Denver. And I think I might be interviewing him again. I did that in February at our craft conference. He's just got a really interesting mix, right? Because he's senior advisor to Allianz and PIMCO. So he's very much hand on the market, and he's president at Cambridge University. So he's got an academic. So he's got both of those perspectives. Really, really excellent. John Authors at Bloomberg has a daily newsletter. Just fantastic. And he's made this analogy recently with central banking and mountain climbing. And his comment over the course of the last 6 months has been, when you're climbing up a mountain, yeah, it's hard, but you just sort of make steady progress. When you're going down a mountain, that's when people run into a lot of trouble because they're already tired and footing is slippery. And he's like, central banks, when they begin to cut, they have all the intention in the world of going slowly, but they run into something and all of a sudden they drop rates like a rock. So that's what markets are anticipating, but he has a fantastic way of talking through that concern.
Well, before you name number 3, and I want to know how to spell his last name too. I think that that's analogous to IMBs as well, because when you're breaking it apart, when you're taking a structure and ripping it apart and downsizing, that's one skill set, right? And you pretty much know what you need to do to cut the cost. But then when you're starting to scale up again, that's a completely different skill set when you're bursting at the seams with production and so on and so forth. So I just wanted to hit that as sort of a side note and something that I've been thinking a lot about that I might write about soon on LinkedIn. All right. So how do you spell John Author's last name from Bloomberg?
I believe it's Authers. But
all right.
I'll send the latest version to you.
All right. People can look it up. And then is there a third, or should we just follow John and Mohammed?
I'm a big fan of Steve Abrahams at Santander. Big fan of Bill Nelson at the Bank Policy Institute, Seth Carpenter at Morgan Stanley. So think of that as sort of the greater Wall Street economist list that I tend to read with enormous interest. And the folks at JPM are fantastic as well. So
what a bonus you gave me! I asked for 3, you gave me 5 or 6.
I read a lot.
I was going to ask you. That was my next question. That was my last question. How much do you read?
Constantly. Yeah, that's. I mean, I think my job is to try to stay informed and to informed from meaning read as many different possible perspectives as I can get my hand on, because I want to be presenting the industry, all of our members, with the best information I can get, and that's not by me sort of holding myself up and thinking stuff. It's I want to understand all the views out there. And there's a lot of smart people out there that are worth listening to.
Have you been known to have sleepless nights thinking about something bouncing around in your head and grabbing the iPhone in bed or getting up out of bed in the middle of the night to like dive in? Is that you, or when you shut it down and the lights go out, you're done until the next day?
So most of my thinking is when I'm out for a run or out on a bike ride or something. So active exercise gets the mind going in my case.
Oh, you must be watching the Olympics, huh?
That's right. Get motivated to go out there and go.
Hey, the U.S. is doing a great job. How far can you run? Can you run 10 miles?
I can. I absolutely can. Yeah.
Have you run in a marathon?
I did sign up for another one this fall. So hopefully
So
the
you
body holds together. Getting old, man.
so you can go 26 miles in the same day.
That's the plan.
Mike, thanks so much for spending time with us. The timing could not have lined up any better. Appreciate all the work you do, and everyone else. You've got an army of incredible people at the Mortgage Bankers Association, and NFM Lending, the company I'm a part of, is a very proud member of the MBA.
Well, thank you for that, and thank you for having me. Great talking with you as always.
All right, I'm kicking you off stage now. We'll talk soon, all right?
All right, see ya.
All right, Mike, take care now. Just a programming note, coming up next Monday at 1 o'clock, Garth Graham, senior partner at the Stratmore Group. Garth recently published an article on the refinances that will be coming and how there'll be far fewer than any of you think. We'll hear why and also hear about the mergers and acquisition activity. Stratmore normally at the epicenter of all of those transactions, and certainly the lion's share of them. Are we done with mergers and acquisitions, or are we just getting started? We'll find that out next Monday, 1 o'clock. Until then, have a great week, everybody. So long.